The one question a lot of people have at the start when they do retire is that they've accumulated a sizable corpus. What do they do with it? How do they allocate it?
Good evening, Alex. Great to be here. Yeah, absolutely. I think this phase when one has done with their active work years and then heading towards a retirement life, Alex, it's a very challenging phase, especially given the way inflation is heading. We'll see the latest numbers in some time: health expenses, longevity of life, the lifestyle changes, and also the social structure. So, given all these factors, I think the allocation really needs to take care of everything. So a very broader allocation, which can, I think, fit for everybody's portfolio, is have a contingency fund for yourself. So let's take an example. Somebody has a corpus of 1.5 crores at the time of retirement. That person can keep about, let's say, 15% aside in their contingency fund, which is about 22 lakhs. Then you cater to inflation and your future expenses by keeping aside another 20 odd percent in equities. Now, this percentage can vary from 5 to 50 to 30% depending on case to case basis. But let's say 20% of 1.5 crores is about 30 lakhs. So that's parked in equities within different buckets with a 5-year, 10-year, 15, 20-year horizon. And finally, Alex, is the tricky part, and which is very challenging, where you are now going to generate your regular income from that remaining, let's say, in this case, would be about 97, 98 lakh rupees. How does one park that? How does one, take care of the taxation part? But taking a very simple 7% return, somebody can generate post-tax returns of about 54,000 a month from this corpus.
Okay. So I think that sets the stage for the rest of the conversation as well. But, I want you to elaborate just a tad bit on the equity component, because I think a lot of people retiring right now belong to a certain generation that was not necessarily very comfortable with equity, but they have dabbled maybe because that crash in 2020 presented a lot of people with the opportunity. Prableen, a lot of people entered at that time, but we're seeing a lot of volatility even as things stand right now. So would you say that it's important to maintain that allocation and to have an allocation despite everything that happens in the equity market off and on, and to still have a long-term view for this portion of your portfolio?
Yes, definitely, Alex. And I'll give you 3 reasons here. Number one, that let's say, somebody starts working at 25 and is working till about 55 or 60. So they have this 30, 35 period with them. And, we feel very comfortable that, okay, I'm investing for my retirement, so I can take exposure to equities. But today, given the longevity of life, our retirement phase is equally long. So let's say somebody is retiring at 55 or 60, and you live till 85 or 90, your retirement life, that phase is again about 25 to 30 years. So I think it makes a very strong case to have your allocations to equities. Inflation is something which spares nobody. And in 30 years, there will be phenomenal changes in the economy, the way interest rates would move. If we move towards how developed markets are, the interest rate will only move lower going forward in the years to come. So I think there's a very strong case to have some part of their allocation decided right in the beginning at the time of retirement that should be invested into equities. And if that is not done, Alex, let's say we are in a phase like today's, where HDFC 5-year FD is giving you about 6.1%. That in somebody with a 30% tax slab, the kind of return the person is earning, you are actually eating into your corpus because your purchasing power is actually going down. So your returns are actually negative because we are not even able to beat inflation. So for your recurring expenses, it's okay to have your fixed income basket, and that has to be the safer part of your portfolio. But allocations for the next 5, 10, 15, 20 years are immensely important in equities.
So actionable insight right from the start, Prableen. You've said build a contingency fund. This is very important because emergencies can happen at any point, including medical emergencies. You've said keep a percentage for equities, which is 10 to 25% based on what your risk appetite is, but do keep an allocation. And the remaining, you've said, is park in fixed income investments which give you a monthly return, right? Or investments that give you
Yes.
monthly return. So let's talk about those fixed income investments. There are various options, but of course, a lot of people of this age group tend to go towards fixed deposits. So let's talk about the pros and cons first of fixed deposits.
Fixed deposits, Alex, I think it's a no-brainer. It's a product which I think majority of us are familiar with, we understand, and that is why I think we all find comfort in investing in FDs. The good part is that it's safe broadly because a bigger bank, let's say like SBI and HDFC, we don't expect them to be defaulting, though only 5 lakh is actually insured. But we don't expect them to go, bankrupt or other things. So broadly safe, you get a predictable return on your investments. And as a senior citizen, you actually get about 0.25 to 0.5% over and above what a regular person would get. And, you can decide the tenure you want to invest for a 7-day or a 10-year or a 2-year, 3-year basis. So the flexibility is there. And a regular investor understands and finds comfort there. The negative is, Alex, that FDs are taxed at accrual basis. That means even if my FD is, giving me an interest and I don't take it out, I don't use that interest, I'm still paying a tax on that. And if I'm using it, of course, so either ways, I'm paying a tax, and that tax is at slab, which is quite high. And in the current scenario, when FDs are not giving a very good return, of course, there is a bit of a pinch which any investor needs to take. But FDs broadly should be a part of your portfolio, but not just bank FDs. I'll touch upon corporate FDs here, Alex, because that is something. Company FDs is where you can look at some good AAA rated, very reputed companies in India, which offer slightly higher rates than the bank FDs, companies like HDFC Limited or Bajaj. And their investors can again look at parking their corpus, but the amount that they get on a monthly or quarterly basis, whatever they choose, is again taxable at slab. But the rating here is important, Alex, and they should not get tempted by the higher returns which are being offered. One should not go and park or lock everything in a company where the returns look better, because there will be a risk of default. So investors must be careful while choosing this product.
Quick point here between bank FDs and corporate FDs. There is,
Yes.
and there are questions, Prableen, that have been asked. Suppose if you're talking about a Bajaj Finance, very large financial institutions, or HDFC, if they're offering rates that are better than the bank, is there any harm allocating a substantial portion of what you would normally allocate to fixed deposits into one of these, or do you have to worry about concentration risk here as well? Would you spread it out, is what my
I think
question is.
Yeah. I think, Alex, it's a good for any retiree. I think the overall fixed income basket should be spread out. So it should not be, let's say that somebody has 1 CR to invest and the person goes and invests 50 lakhs into one company. If we just go back a little, what happened with 81 bonds, Yes Bank, they were offering about 9.5%. And I think we've seen such sad stories there where a lot of money has been locked up in those and will not probably be received by those investors. So I think allocations to even good companies should not be very high, restricted to maybe about 15 to 20% of your portfolio. And Alex, as we go down the ratings, AAA, let's say, is offering about 6.7. If I'll give you an example of Shriram Transport, it's a good company, but it's offering higher. It's offering about 7.62 plus 0.5%. So wherever you see slightly higher returns, one must go and check, why am I getting these higher returns? It's never without some sort of an associated risk with it.
The easy way to think about it is, if I need a loan and if I'm going to the bank, if the bank thinks that I'm going to default, it will charge me a higher rate of interest. So effectively,
Yes.
it is that. It's the opposite way of thinking. It's that
Absolutely.
you're giving the loan to a company. Okay, let's talk about the
Yes.
government-backed schemes, because there are quite a few to consider and some quite attractive. In fact, let's talk about the Senior Citizen Savings Scheme, because this is quite a popular product as well. What, Prableen, are the key facets that you would say make it a good product?
Within these government schemes, I think senior citizen savings scheme, as you said, Alex, is one of the best options because it was launched when in 2004. The primary aim was to help retirees generate something on a quarterly basis. And though this investment is now old, and I honestly feel that the limit should also be increased from the 15 lakh per person because, with time as inflation increases and the sizable corpus that people are generating today, so it should go up. But currently, it's offering 7.4%, and it is paid out on a quarterly basis. I think 7.4 is good with the sovereign backing. In the past, we've seen senior citizen savings scheme even give as high as 8.7% returns. So it's usually a spread of 1% more than the government securities, Alex, in the market. So it's a market linked thing. Every quarter, we do get the fresh rates for these schemes. And here, the limit for the investment tenure is about 5 years, which is extendable by another 3 years. And the interest earned is taxable at your income slab. Moving on, then we have the PMVVY, the Pradhan Mantri Vaya Vandana Yojana. Now, Alex, this was launched in 2017. This is a relatively new scheme, and initially it was launched for a year. But I think it's been, very well received. And currently, it is open till 31st of March 2023. The interest rate offered here is again 7.4%, and the same 15 lakh can be invested. The payouts are, in multiples. Here you can choose a monthly payout. It can be a quarterly or twice a year or an annual payout. So that's the difference. And here the interest gets locked for the whole 10 years. The tenure for this scheme is 10 years. So I think these two are very good products for retirees who are looking to generate their retirement, income on a regular basis. Next is the floating rate saving bonds. The good part about this particular scheme is that there is no upper limit. So Alex, for somebody who's looking to park their money, not only to generate a monthly income, but otherwise also can consider these. The interest is paid out twice a year, and it is a floating rate. So the National Savings Certificate, whatever that particular instrument gives, it is 0.35% over and above that. And there is no age limit. It is not only for senior citizens, it is for everybody. And again, the interest earned is taxable at slab, but no upper limit. So that makes this product quite interesting, plus the floating rate. And the fourth one here is the very popular scheme by the post office, which is the monthly income scheme. Here, I think the disadvantages are that only 4.5 lakh can be invested by an individual, which is very small. Probably this was okay like 10, 15 years back, but now with the kind of corpus that people need to park at retirement, it's a very small amount. And the interest rates are also low currently. It's only about 6.6%. It is a 5-year scheme. So I feel out of these, the first three are the good options.
Now, when you're talking about taxation, Prableen, all of the schemes that you've mentioned so far are taxable at slab rate. But there are debt mutual funds which offer you interest, which after 3 years becomes indexed and you have long-term capital gains. Yes. So there is an advantage, which we have addressed multiple times on this program. First question is, how do they compare to the rates that are offered to senior citizens? Because like you mentioned, they have a markup that they earn compared to everybody else, particularly if you're talking about fixed deposits. There would, of course, be that aspect of post-tax that you have to consider. So net, are debt mutual funds still superior? And then the second point is systematic withdrawal plans, because if you have a sizable corpus in debt mutual funds, you can have a systematic withdrawal plan over the course of a few years to have that monthly amount. Is that beneficial?
The first part, Alex, yes. In certain segments, I would say the returns are comparable. At some places, like we saw the trend in the last 1.5 years when the interest rates by RBI were really reduced. Overall interest rates have been down. So as compared to FDs, even debt funds weren't offering good returns. But that is the time where the government schemes have been scoring because, they were retaining that 7% plus sort of a return. Otherwise, debt funds are usually comparable to fixed deposits, and they do have the edge in terms of taxation. And taxation, I think, is a very, very crucial component, Alex, which we all tend to miss while selecting the product, because that can actually make a lot of difference to your post-tax returns and what a person can generate on a monthly basis. Having said that, even the longer duration products in debt funds are now offering 7% plus. But of course, there will be volatility and there will be interest rate risk there. But they're again sort of sovereign schemes, especially the ones which are, we have a lot of debt index funds which are now investing in government securities. So there is total sovereignty and there is no risk of default, and they're offering very good returns. Now, how these debt funds can be used through SWP? In fact, not just debt funds, Alex. A systematic withdrawal plan can be used even for hybrid sort of schemes where it's a balanced advantage fund or a conservative hybrid fund. The idea is it's the opposite of an SIP, where instead of investing something on a monthly basis, we are withdrawing something on a monthly basis. And over a period of time, you have the predictability of what you want to withdraw on a monthly basis, of course, based on the calculations that broadly what that scheme can generate for you. So there will be times when you may be eating a bit into the capital as well, but that can be made up, as markets progress and as the markets recover. But they do have an edge in terms of three very important things. Number one, any withdrawal, which is done systematic withdrawal plan, only the appreciation part is taxed and not the principal that comes back, because any SWP is a mix of the two. So Alex, that really reduces your tax component. Second, that because long-term capital gains and short-term capital gains apply, again, the tax liability goes down. For an equity as it is, it's much lower as compared to fixed deposits. And even if it's a debt scheme post 3 years, because indexation would apply, the taxation would be way lower. There is no TDS, that is another advantage. And another very important advantage is that in case you're withdrawing from it and the markets are down, any sort of a loss which is booked can be set off against a gain. So net, Alex, SWP, I think, is a very good option, especially for those who are, in the 30% slab. Investors who are in the, lower tax slab can still skip it, but I think it gives a great opportunity to investors in higher tax slabs.
Now, Prableen, real estate is something that for a lot of people is a very, very important asset class. They've invested in it sometimes as a second property that will give them a monthly return or a monthly earning. A lot of people who have retired say, I'm comfortable right now because I'm getting rent from my property. Is that a positive way to approach things? Is that something people should consider doing?
Alex, I think real estate in India are huge allocations to this particular asset class. So I will not challenge this view. I think it's great to have a source of passive income coming in from real estate. But I think how it is built is important. During your work years, if you were able to take loans and you managed it well and you've been able to create an asset for you, wonderful. But now at the time of retirement, let's say you get 1 crore, and do you want to go and buy an apartment, let's say for 70 lakhs and then generate rental income from it? I think that is questionable because the rental yields in India are not very high. It's about broadly, let's say about 2.5 to 3%. An apartment which will be, let's say, 1 crore in today's time can generate about 30 to 35,000 per month as rent, which is not very high, Alex. So doing this and taking this as an option post-retirement is, I think, depends again on case-to-case basis. If you're choosing a tier 2 city or are you choosing a commercial property? So it'll depend on a lot of factors. But yes, it does give a lot of sense because there's capital appreciation as well. But the ticket size is very huge. So it's a big ask and your money gets locked up as well.
I want to talk about a couple of other options. I remember we did a very detailed chat on dividends, so let's not delve a little too much. And by the way, viewers, if you want to look at this chat, it's available on social media, and I will tag it with Prableen's handle as well so that you can have a look at it later. Very quickly, could you give us your view on what the approach should be to dividend investments, stock investments that give dividends?
So dividends again, Alex, if it's built over a period of time, while we are building up our corpus for retirement, and I keep buying stocks which can give me dividend during retirement years, it's great. But again, just going and parking your money in dividend-paying stocks will not be able to suffice your monthly expenses. An approach here which can be taken is that the allocation, the equity allocation that we spoke about right in the beginning, maybe a part of it can actually go towards dividend-paying stocks, a healthy portfolio, and that can supplement your monthly expenses as well, some income coming in terms of dividends, and give you the advantage of capital appreciation as well over a period of time, the benefit of investing in equity markets. So some exposure can be taken over there to dividends.
The other aspect is, and it's not always a choice, a lot of people have to invest in annuity schemes, particularly if you've been putting money in NPS, though NPS is relatively newer. This is a conscious choice that a lot of people take. What should the approach be to investing in annuities, Prableen?
Annuities are offered by insurance companies, Alex, and like you said, NPS, 40% has to be invested. I think a lot of aspects need to be seen here. So there are certain annuities which say that you invest and we'll pay you something on a monthly basis till the time you live, and we don't return you anything when you are no more there. So there is nothing which is paid, let's say, to the nominee. There are other options which say that we pay you X amount over a period of time that you live, and we'll pay this amount to the nominee. Then there are annuities which are for limited time period. But broadly, Alex, if we look at the returns which they are offering, so where the your initial investment can come back to you, the returns which are generated is about 5 to 6.5%, and where nothing comes back to you is about 7 to 8.5% sort of returns. So the advantage is that that for the rest of your life you can get that X%, but with inflation, will that X% suffice 25 years from now? The disadvantage is that you don't have access to your own capital, because once it's invested, it's sort of gone. So that has to be seen. What's your personal requirement, and then only an annuity should be picked, because there are multiple variants and variations available through these products.
And I think just to sum up, you've broken down all of these schemes, but again, I think I'll stress the point that you made on the diversification aspect, even in the fixed income portfolio. Yes. You said that it's important to hold a combination of various fixed income investments, and this is the right way to approach it. Thank you so much, Prableen, for taking the time. Always a pleasure speaking with you.
Thank you, Alex.